I don't know what the latest ones are as of today, but as of recently, the average analyst expectation for S&P corporate earnings next year was still up 10%,
Yeah.
despite the slowing economy and all these other things, right? So it's like at this point, it feels like a fantasy, or at least if you're on the numbers, it
Yeah.
definitely slaps you in the face as such. And so we've been saying, hey, when, in mid-July, when these companies really start, announcing having their Q2 earnings calls, we're very likely going to see the street and analysts getting disappointed as these companies bring down their forward projections. And that's going to force the analysts to have to revise their models, bring down future earnings projections. And mathematically, that would bring down, what they're putting out there as target prices for stocks, right? And we got some validation on that just the other day when Micron announced their recent earnings, and they crushed it from both a quarterly earnings and a revenue standpoint. But their forward projections were so disappointing that the stock just got clobbered. And I sort of looked at that as validation of what we're talking about here. It's like, yeah, I think this is a preview of what's to come. What do you think?
Well, no, you're absolutely right. I want to. We're going to solve a couple of myths here while we're talking about this. But it's not just Micron that has been really guiding down on forward estimates. If you take a look at negative earnings revisions from companies, right? There's been a very, very big tick up in companies reporting much weaker than expected. They killed it on earnings, to your point, but then their forward guidance was so terrible that it just crushed the stocks. Netflix was a good example of that. The earnings were okay. It was their forward guidance that killed them. And, we saw this from company after company after company. Amazon was another one. And these stocks were getting clobbered. They were down 10, 15, 20%, and then went lower even after that. But let's solve a couple of myths here real quick. One is I read this article today that said, yes, we've had 2 quarters of negative GDP growth, but that doesn't mean we're in a recession because the economy, the consumer has so much cash on their balance sheet. They're completely ready for this whole recession. So yeah, we had 2 negative quarters of economic growth, but it'll be okay because the consumer is so well heeled. They're about to pick up spending and it'll all be fine. That's a complete fallacy. So, we talked about this before, a big bunch of those savings are held by the top 10% of income earners, not the bottom 90%. And, we run this analysis. I was actually on Charles Payne yesterday talking about this very thing, saying, if you take a look at the average household and their standard of living, so if you take the standard of living and run it back to the 1960s and inflation adjusts that over time, that gap between just what they have in income and what's reported as savings requires an additional $6,300 a year in debt just to maintain their standard of living. And this is why we're seeing personal consumption expenditures decline. We're seeing retail sales decline. We're seeing, all this kind of weakness on that spending front because their wages aren't keeping up with the cost of living. And now they're having to make those decisions about, well, what am I not going to buy? Right? I'm not going to travel this summer. I'm not going to buy these things. I got to just try to get by right now. And they're not set up for it. You just sent me a great article last week that I'm converting into an article for our website, giving statistics about the average household savings. It's just, dismal, when you look at the average household. Now, the other myth is, and man, people have got to get this out of their head because this gets repeated ad nauseum on the media. They say the stock market is not the economy. That is a true statement, except it's totally erroneous because yes, the stock market's not the economy, it's the stock market, and the stock market can do things sometimes that's not reflective of the actual economy in the short term, i.e. we can have little, like bubbles caused by a lot of monetary infusion like we saw in 2020, 2021. But historically, going back through history, there's a very high correlation between 2 things. One is economic growth. The other is earnings. And the reason that those 2 are highly correlated is because the earnings and revenue for companies come from where? Economic activity. The stock market doesn't exist in a vacuum all by itself. It is directly tied to the incomes and revenues that are generated by the economic activity of what, you and I are spending in the economy. We go out and buy a new Apple Watch, or we buy a new Mac, or we go buy a new car. That's where those companies' revenues come from. They just don't magically show up somewhere. So yeah, markets can deviate because we get very excited at times and we run stock prices up well ahead of earnings. This is how we get overvaluation. Then there's points where the stock market can run down and be more depressed price wise than what earnings are truly showing. And that's how we get undervaluation and get those good buying opportunities. But the stock market may not be the economy, but the economy and the stock market are very integral to each other. And you can't dismiss those two. So if we're talking about an economic recession, it's going to impact the stock market because ultimately investors will reprice earnings to adjust for that decline in earnings relative to the price they're paying for that future form of cash flows.
Absolutely. And just to even simplify things further, really the relationship there is the stock market is a multiple slapped on the earnings that the economy is producing. Right.
Same thing. Yep.
And because of that, the stock market actually is supposed to be a bit of a forecasting vehicle because the stock market really is pricing forward earnings expectations. Right. So if the economy is likely to perform less well in the future and analysts are doing their jobs, right, then stock should actually correct before the actual economy slows down. They should be predicting that in advance if they're doing their job right.
And they do. And if you go back in history and look at, we talked before, by the time the National Bureau of Economic Research dates the recession, right, it'll be 2 quarters from now or 3 quarters from now. Right. They'll come back and say, oh yeah, the recession actually started in January of 2022, right? And we'll go, oh, well, thanks for telling me now. But the stock market was already going down. If you go back through history and look at where the National Bureau of Economic Research actually dated the recession. So on what date did they say the recession started? So example, we talked about it before here in our conversations. In December of 2008, the National Bureau of Economic Research came out. The recession started in December of 2007. So if you waited for the announcement of the recession, you completely missed the bear market, right? But the bear market occurred and was telling you we were in a recession. It just hadn't been dated yet. And if you go back through history, there's always about a 6 to 9 month lag, sometimes a little bit more, sometimes a little bit less. But there's about a 6 to 9 month lag between the actual, downturn in the market and when the recession actually gets dated. So again, this is why, as investors, we have to pay attention to the real-time data, pay attention to what the market's telling us. And the market's telling us that earnings estimates are too high. Those have to come down. The economy is a lot weaker than what we currently expected is from the trailing data. And investors are pricing all this in right now.
Yeah. So very, very well said. I think the important thing just to underscore here is as the conditions deteriorate, there are certain parties that have to be involved in that, right? There's the companies that have to say, hey, we know our business better than anybody else, and we think this is what's going to happen going forward. Then there's the analysts who have to take the company information and then run that through their models and say, okay, we think a fair price for this stock is X. And then there are investors who have to consider all that data and then make up their mind at the end of the day. And just one of the things that we're kind of putting our finger on right here is we think it's pretty clear that the fundamentals are deteriorating. A lot of companies are beginning to agree with us. The analysts haven't yet fully corrected their models yet. So there is a bit of an arbitrage moment here right now where I think those paying attention are saying stocks are probably still on average valued too high right now, given what we think the revisions are going to be. Now, time will tell whether that's right or wrong, but we're in this really sort of interesting time right now. For whatever reason, the analysts have just been reluctant to pull those forward earnings down into the world of reality yet. If you enjoyed this video clip, click here to watch another one you should like.